Chartmogul, an analytics software for subscription-based businesses, recently released a retention rate benchmark report based on more than 2,100 SaaS businesses. If you're a SaaS founder or an investor, I suggest you read the whole report as it is both very interesting and pleasant to read. But as for this video, as I invest mostly in pre-seed and seed SaaS companies, I will focus on what we can learn from early stage SaaS startups when it comes to their retention metrics. The benchmark is broken down into several ARR ranges, and I will focus on the retention rate metrics of the businesses in the sub $300K ARR range. So a MRR at around $25,000. Usually, startup will reach this level of ARR/MRR, have barely reached a PMF, or have a weak one. So their retention metrics might not be as stable as the later stage companies. And to finish on this introduction, as a side note, the retention rates that you will see in the rest of this video are measured over a 12-month period. As a reminder, the gross revenue retention rate corresponds to the churn in revenue without taking into account revenue expansion and upsells. Basically, if you start the year with 10 customers paying you $1,000 per month in total, how much of this $1,000 monthly dollars is left at the end of the year without taking into account expansions and upsells? Chartmogul report doesn't start with this metric, and for good reasons. But in the case of seed startups, I think it's interesting to start with gross revenue retention rates because the vast majority of startups at 25K of MRR do not have significant upsells yet. This graph breaks down the gross revenue retention rates by ARR range. And if we zoom on the sub 300K segment, we can see that first, the median gross revenue rate is 53%. So they lose almost half of their existing revenue on a yearly basis. Second, the 75th percentile, aka startups with a better gross retention rate than 75% of the pool of startups surveyed, has a gross retention rate of 72%. So what can we learn from these numbers? Well, first, if you are a seed SaaS startup at around 300K of ARR, and you have a yearly gross revenue retention rate which is more than 53%, you're already better than the majority of similar SaaS companies on the market. And if you are way above this mark, you can confidently share this metric when you fundraise. The second lesson for me is that if you are below 53% of yearly gross retention rate, then you need to try to figure it out why. Is it because you don't have a first PMF and basically haven't found yet the good customer segment or pain point to go after? Or is it because you do have a PMF, a product market fit, but your product is more of a vitamin than a painkiller? Or is it because you are a painkiller, but your product is not ready yet and lacks features, which explains why customers churn? If you fundraise and have below median metrics, you should definitely understand the underlying causes and be able to explain it. As a side note here, you can also ask yourself the same questions by analyzing your yearly customer retention rate, aka how many customers that you had at the beginning of the year are still left at the end of this year. As you can see from the graph in Chartmogul's report, the metrics are similar to what we have for the gross revenue retention metrics. The median yearly customer churn is at around 53%, meaning you will lose half of the customer you had at the beginning of the year. And you are in the 75th percentile when your yearly customer retention rate is at 72%. As a reminder, the net revenue retention rate corresponds to the evolution of your revenue, taking this time into account revenue expansion and upsells. Basically, if you start the year with 10 customers paying you $1,000 in total monthly, how much do these 10 customers, or less if some have churn, pay you at the end of the year on a monthly basis? If you have a lot of revenue expansion and upsells from these existing customers, you can, for example, finish with $1,500 of monthly revenue. So, with a net revenue retention rate above 100%. But if you have no revenue expansion/upsells, then your net revenue retention rate will be below 100%. On this graph, covering the net retention rate metrics, we can see that for our sub 300K ARR segment, first, the median net revenue retention rate is at 57%, and second, the 75th percentile has a rate of 79%. There are a couple of interesting takeaways from these numbers. First, revenue expansion and upsells is clearly not a driver that you find in early stage startups. Even the 75th percentile has a net retention rate way below 100%. Another graph in the report shows that actually only 7% of startups with a sub 300K ARR have a net revenue retention rate above 100%. So if it's your case, chances are high that you won't stay too long in this range, and that if you are raising money, you will have very strong arguments to put in your deck. The second takeaway for me is that founders and investors at that stage should ask themselves what is the potential for a company to generate upsells and revenue expansion later once they reach a strong PMF. So do you believe that there is a path to increase net revenue retention? If yes, is it by going up market and targeting bigger customers? Or is it by upselling the existing customer segment? And if you think that it's possible to do revenue expansion with the current customer segment, how will it be done? Thanks to usage-based or seat-based pricing, or because you can expand the scope of your product in the customer stack, for example, by getting into payment like many vertical SaaS do, etc., etc. So even if most startups at that stage do not have a net revenue retention rate above 100%, it doesn't mean that they won't reach it in the future. So it's worth thinking about the potential path leading there, and if you believe that the company/founders have what it takes to do it. The last aspect that I want to touch upon is the average revenue per account, 1. There's this kind of law in SaaS, like the gravitational law in physics, that say that if you want to have a lot of revenue expansion and upsells, you need to have a high ARPA. The lower the ARPA, the less chance you can upsell your customer. And even if it's something we know already, it's always interesting to visualize it in real life. On this graph, the team at ChartMoguls has mapped net revenue retention rates with ARPA ranges instead of ARR ranges like we saw previously. And you can clearly see the correlation between a high net revenue retention rate and a high ARPA. It's very hard to escape net retention rate velocity if you have a low ARPA. Almost mission impossible. In terms of takeaways, no real new insights here, but some stuff that are worth remembering. First, if you are a seed SaaS startup with low ARPA, then you either need to show how you will grow this ARPA, like going up market, for example, or to show how you will build a lead generation rocket ship. With a low ARPA, you need to be outstanding with lead generation and low touch closing. Second, if you have a high ARPA at seed stage already, then it's definitely something which is rare first and that you should highlight when fundraising. That's it for me. This report contains many more gems, so I suggest you reading it if you are interested in the topic. Cheers.